Good afternoon and welcome to today's webinar titled PSD2 SCA, How Ready Are Issuers for the Upcoming 31st of December deadline? Thank you so much for joining. My name is Mélisande, Mual, the publisher of the Paypers, and I'm delighted to co-host this webinar with Ekata. In October, Ekata partnered with STRATGranat to conduct an interview campaign with leading European issuers in order to understand how they are going to respond to the upcoming deadline on the 31st of December. In this webinar, we will give more insights into the demographics of the survey, the key findings, and its conclusions. And before we kick off the discussion, I would like to start with some quick notes regarding housekeeping. The presentation will take approximately 40 minutes, and we will have 10 to 15 minutes for a Q&A at the end of the webinar. You can ask questions at any time throughout the presentation by typing your questions in the Q&A application. During the presentation, we will compile your questions and I will ask them at the end of the webinar. Today, I'm joined with two seasoned experts in this industry. Great to see you, Catherine, and great to see you, Spencer. Could you please introduce yourself briefly?
Absolutely. Thanks, Mélisande. Hello, everyone. Good afternoon. My name is Spencer McLain. I'm General Manager of EMEA for Ekata. So I'm responsible for Ekata's commercial efforts across Europe, the Middle East, and Africa. For those of you who don't know Ekata, we are a global identity verification company helping acquirers, merchants, and issuers understand the risk behind phones, addresses, emails, and IPs, and how those tie back to names. I've been with the company for about 6 years now in a variety of roles, and I've been leading a team in Amsterdam for the last year and a half.
Okay, thanks. Catherine.
And great to be part of this presentation with you both today. Thank you. My name is Catherine Tong. I am a co-founder and partner of STRATGranat. We're a payment services company, independent payment services company based in Europe, albeit working globally with merchants and vendors across the space. I've been in the fraud and payment space for just over 20 years now, having worked at Tesco as a merchant and a Certify as a vendor, and looking forward to sharing some broader industry insights as part of the study that we did with Ekata earlier on this year.
Okay, brilliant. And so thank you. And please, for the audience, don't be shy to reach out to Spencer and Catherine in case you have any questions throughout the webinar. So Spencer, over to you.
Yeah, thanks, Mélisande. So today we're going to go through a survey we did of issuers to answer the question, how ready are the issuers for the upcoming deadline? And we're excited to share these findings with you because we feel like this is one of the biggest open questions in the ecosystem today. What's going to happen come January 1st when all these countries go live? Will it be pandemonium and a disaster, or will it be okay? And I think we've effectively come up with some really good answers to those questions that we're going to share with you. And so here's the agenda for today, if you will. We're going to give you some context on the study, go through the methodology, the findings, and then we'll close and go into some Q&A. So diving right into it, to start, what you got to think about what's the intent of PSD2 and SCA. And ultimately, the intent of it, from our perspective, is to help make payments safer and protect consumers from fraud, right? Like there's a lot of nuances to that, but if you boil it down to the ultimate intent, like it's really about protecting these consumers and making sure the cardholders aren't exposed to fraudulent activities. And it comes with a lot of, friction and whatnot around with strong customer authentication and, the exemptions that acquirers and merchants can apply for, and we'll touch on some of that. But really what PSD2 is doing in Europe is it's fostering innovation while allowing all of the players in the ecosystem to treat it as a strategic differentiator potentially, because ultimately PSD2 enables some consistent mechanisms to share merchant intelligence down to the issuer. And in the long run, we believe that PSD2 will be a very positive thing for the ecosystem that will ultimately result in reduced fraud rates across the board and increased authorization rates.
Great, Spencer. For the sake of scene setting, could you elaborate a little bit on the different roles of merchants, acquirers, and issuers in PSD2 SCA?
Yeah, thanks, Mélisande. So just to set the stage a little bit, because we're going to be talking about a lot of different technical mechanisms in the ecosystem. And so I think it's good to just level set what are the parties in the authentication and authorization rails. And so authentication is basically a merchant and an issuer trying to answer the question, is this consumer who they say they are? The most common form of authentication is 3D Secure. We've been using 3D Secure for quite some time. And then, as part of PSD2, the 3D Secure 2 protocol will be primarily used, and there's various states of readiness there. And so in the authentication flow, you have a merchant that uses a merchant plugin to pass down data to the directory server. So that's the card schemes, Visa, MasterCard, American Express, etc. The data is then passed down through an access control server. And so you have parties like RSA, ARCOT, Cardinal Commerce, etc. Some issuers build their own access control servers, and the access control server then passes the data down to the issuer. And then the issuer says, okay, well, this looks good, and I'll take liability for this transaction. And we'll touch more on liability in a moment. Or they'll say, this doesn't look good to us. We're not going to take on liability, merchant. It's up to you to decide what to do. And so after the authentication flow, you have the authorization. Now, keep in mind that authentication doesn't necessarily have to happen. PSD2 mandates SCA on European transactions, but there's exemptions to that. Today, across the entire European Union, I estimate about 30 to 35% of transactions go through some form of SCA, especially in countries like the Netherlands, where you have Ideal, for example, which mandates SCA on virtually all card not presence transactions. But for the transactions that don't go through authentication, they go through authorization. All the transactions go through the authorizations if the merchant decides to submit those. And so this is a more common scheme, but the merchant works with a gateway and an acquiring processor to then pass the data down to the card scheme, and then the card scheme passes the data down to the issuer. And the issuer says, okay, they look at the bank account of the consumer. Does the consumer have enough money in their bank account to pay for this? Or do they have a big enough line of credit to pay for this TV or whatnot, whatever they're buying? And then the issuer says yes or no, we authorize this transaction or not. And then that passes down to the merchant, and the transaction's approved, and the merchant then ships the product to the consumer. So really high level overview, but important to set the stage there. So moving on a little bit. So when you look at the data that's passed down from 3D Secure 1 to 3D Secure 2, there's an order of magnitude more data that's being passed down. And that, in theory, should lead to much more accurate decisions being made. So in 3D Secure 1, you had about 10 fields. And you can see a sampling of those fields on the left side of this slide. But in 3D Secure 2, you're getting so much more data that's passed down as part of the authentication rails. And so issuers should be able to make better decisions around this once they invest in the data science resources to really understand what this data is saying. And keep in mind that historically, the issuers haven't seen a lot of this data, and so it will take some time. But we are seeing some very encouraging things on the issuer side that indicate that the issuers are more ready to receive this data than we thought otherwise. And we'll get to that in a bit. And so, we view PSD2 and strong customer authentication as a strategic tool for both issuers and acquirers, right? Because ultimately, issuers, they want to stay front of the wallet. And if you're a consumer and your transactions declined and you really want to buy that TV, Xbox, whatever, you're just going to try another card. And once you move that card to the back of your wallet, like the chances that you bring that card back up is very slim. And PSD2 does impact customer experience. And so it's in the merchants, the acquirers, the issuers' best interest to ensure a very strong customer experience and to allow for as many exemptions to be available as possible. Because once the consumer is encountering friction, there's a good chance that they're going to abandon the transaction, especially in the 3D Secure 1 protocol that's still being heavily used today. That involves pop-ups and things that look like phishing attempts, and it scares consumers in some ways. And so we believe that if the parties, the issuers, the acquirers, the merchants, if they invest in differentiated offerings around PSD2, that they'll be in a position to utilize this rich data, apply for more exemptions, reduce fraud, and then reduce the compliance risk that comes with PSD2. And we're going to be talking a lot about this during the presentation today, like what percentage of issuers are just viewing a PSD2 as a compliance requirement, and which ones are viewing it as a strategic differentiator, and what does that exactly mean for them?
Spencer, a bit earlier you talked about liability. Could you elaborate a bit on how liability plays out in PSD2 SCA and what will change in terms of the shift?
Absolutely. So this slide we borrowed from our friends at ACI. They have some really great collateral around what SCA is and how liability shift happens. And so when you look at the use cases on the left, and then what the merchant does in the middle, and then the ultimate liability on the right, in 3DS, the merchant initiates the 3DS call through their merchant plugin and whatnot. And then if the issuer accepts authentication requests, the issuer has the liability for that transaction. And if the merchant's not 3DS enabled, obviously they can't apply for 3DS, and so the liability will stay in that case with the acquirer or the merchant. In most cases, the merchant. Although we have heard from some acquirers that they are using this as a differentiation to take on liability for behalf of their merchants, which I find very interesting. And then you get into the PSD2 world at the bottom in these bottom two. And so if the merchant applies for an exemption and the exemption's granted, then the merchant or the acquirer will keep liability for that transaction. If the issuer requests a step up and declines that exemption, then the liability will shift over to the issuer side. And then finally, on this bottom row, if it runs through SCA and the issuer accepts that, the liability will shift to the issuer. But the common theme here is that PSD2 will result in more liability shift from the merchant to the issuer, which is a great thing for merchants, but it can be a scary thing for issuers. I was just on a roundtable earlier today, actually, and we were talking about the fact that when an issuer takes on liability for a transaction, they're actually less likely to authorize that transaction, which on one hand, it makes a lot of sense, right? Because they have liability for that. But then why did they accept the authentication request to begin with? And ultimately, there's this disconnect between the authentication and the authorization at the issuer side that the issuers will be working to resolve. But right now, it is, in my opinion, in the best interest of the merchant to avoid SCA and 3D Secure as much as possible, because it will, in the short term, result in reduced authorization rates. But in the long term, it should increase authorization rates. And we'll talk more about that in the context of the study. And so my last thing to touch on, that was my last thing to touch on before I hand it over to Catherine to take us through the study itself. Catherine, take it away.
Thank you, Spencer. So the study that we did actually complements two studies that we've done earlier on in the year, more with a focus on PSPs and acquirers. So we wanted to make sure that we've got a view of the whole ecosystem and looking at this from several different perspectives. Obviously, when we looked from an issuer perspective, there was a much larger population for us to go and survey and speak to. And the way that we decided to approach this was to meet with a combination of independent issuers as well as platforms. So these are companies that are providing the actual issuing software that enables generally the smaller issuers to issue cards to their card members. We made sure that we had good coverage across the European region. But when it came to individual issuers, what was quite interesting, it was the UK and France who were by far the most interested in participating in the study and sharing information with us. Maybe the UK isn't so surprising. It's the largest card issuing market in Europe. We like our cards in the UK. We like spending with them. France and Spain, though, both of those countries, anecdotally, we were hearing were a little bit more behind the curve. They weren't as prepared for SCA and were finding it a little bit more challenging. But actually, the French issuers that we spoke with have given us some really good insights and input that we'll be sharing shortly. The other thing that I think is interesting is the countries that, from a timeline perspective, they put a line in the sand pretty early in the day. UK was one of those, and issuers do seem to be a lot more progressed in their implementations and their thinking around strong customer authentication. I do believe, though, that from a Spanish perspective, things have been a little slower because a definitive date wasn't given as early as France and the UK. Their timeline has been squeezed in terms of from the date that from when the dates were set to the actual date of 31st of December this year. That's your deadline. It's not moving. You have to get there. And so you'll see a bit more of a focus on those two countries specifically as we go through, but we have also covered other countries across Europe as well. And in terms of scale, we've covered both country leaders, card issuing leaders, as well as medium players in the independent issuer space as part of this study. So moving on to some of the challenges that issuers faced. Spencer, do you want to go into those in a little bit of detail first?
Yeah, absolutely. I think that the common theme is, we didn't start it early enough as an ecosystem, and it's not just the issuers, it's the acquirers and the merchants too. We had a bit of a boy who cried wolf situation going on over here, where like everyone expected the EBA to move the deadline again, and then when they came out and said that it's not moving, everyone's like, oh, well, we haven't really started on this, so let's get started now. And then they dove into it and they realized that, oh, well, we need to interpret the regulation itself. And there was a lot of challenges around that to develop a clear understanding. The regulation leaves a lot for interpretation, and that interpretation took some time to sort out, which caused deadlines and the roadmap to to shift a little bit. And they had to factor in the customer experience, like what's going to happen with the consumers, and what's that experience going to look like, and then what what type of education should we do? We heard early on that some merchants were educating their consumers in even Q1. I got an email from GoToGate, which is an OTA in Europe, and it was saying, hey, you're going to start seeing a lot more 3D Secure on our transactions. This is what your experience is going to be. And that education was really important. And issuers have been doing that, and will need to continue doing that rolling into next year, because a lot of consumers, they don't know what's coming, and that will lead to abandonment problems. And then finally, this bottom note is around the vendor coordination. And so we talked to a lot of issuers and issuing platforms, and there was a common theme that a lot of people assumed that their partners would take care of this, like an access control server, for example. They're like, oh yeah, our ACS will handle this for us. And then at the 11th hour, they discovered that, oh, well, the ACS isn't ready, which means we're not ready. And what's going to happen come the the deadline at the end of the year? So there was a lot of execution challenges that were encountered that are still being sorted out. So yeah, Catherine, do you have anything to add on this, or should we carry on?
Well, so I think on the last point is an interesting one, Spencer, because the reality where issuers are relying on a third party to deliver what strong customer authentication is requiring, it means they're in somebody else's hands. And I think, as is often going to be the challenge, and independent issuers are finding, some of those platforms, their roadmaps and their project plans maybe aren't going to meet the deadlines quite as they had hoped to. So I'd like to think, as we do get ever closer, albeit we're only about 3 weeks away now, there will be some pragmatism when we get closer and closer to the deadline. That the reality is nobody in the ecosystem wants significant numbers of transactions to be declined. That's not in anybody's interest. It's not in, whether from a regulator perspective or any of the stakeholders within the process as well. But obviously, the more people that are involved in the development of these new features and functionality, it just makes it even more complex, and it wasn't straightforward to start with.
Absolutely. So one of the things we tried to answer was, what portion of issuers are just viewing it as a compliance requirement, and what portion of issuers are viewing it as a differentiator. And so what you're seeing here is some quotes that, as a result of the survey, we found that a little bit over half of issuers were focusing on compliance, which is to be expected. I actually expected this to be higher, honestly. So I view this as a very positive slide, because almost half of the issuers are viewing it as a differentiator. And this quote on the right here, it's like this bank on the top right, they say, yeah, it's a must do, but it is an opportunity to improve the consumer experience over time. And so, these issuers, some of these issuers are, just viewing it as a compliance focus to start, but over time, they're viewing it as an opportunity to improve the entire experience for consumers, to increase authorization rates, to reduce fraud, which I think is really encouraging. And I think that if merchants, acquirers, and issuers are all aligned on this point, that we'll see, in the second half of next year, a lot of really positive benefits, and we'll look back and say, hey, PSD2 actually was an incredibly positive thing, even if, there will be some stumbling in January. And I don't expect the stumbling to be much farther than that, honestly. Like Catherine was saying, it's in no one's best interest to decline transactions. And if a huge T1 merchant, for example, isn't quite ready with PSD2, like, do you think the issuer is going to just decline all of those transactions? No, probably not. But there will be some learnings that will take along the way. But it is really encouraging to see that almost half of the issuers that we surveyed are viewing it as more than just a regulatory duty, if you will.
So moving on to exemptions a little bit, and I see we've had a few questions around exemptions as well, so I hope I'm going to be able to answer the questions as I talk through this particular slide. The two, what we believe are the two most important exemptions that should be considered as part of SCA are the transaction risk assessment exemption, the TRA, and the low value exemption. Now, what's interesting for me on these two, what our survey showed is that the volume of transactions that are being flagged so far is showing that actually the low value exemptions are being used more than the TRA exemption. The reason that surprises me is that if you think about the low value exemption, that's actually got a limit to it. And it's a limit that as a merchant or an acquirer, you don't know if you are about to exceed that limit. And what I mean by that is low value exemptions can only be used 5 times before you need to go through SCA. Well, it's either 5 times or you spend more than €100. Whereas a TRA doesn't have that kind of invisible restriction. So as a merchant or an acquirer, if you're wanting to apply for an exemption, if you're confident that it's a low risk transaction and therefore you're asking for that TRA exemption, if you're asking for it, you've got a little bit more insight as to whether you feel that whether the issuer is likely to approve it or not. Whereas where there's the hard barriers of a low value exemption, you just don't have that visibility, unless, of course, I guess you've seen transactions going through your world in relatively quick succession. And thinking about the wider industry, certainly some of the analysis that I've seen and heard, it's expected that TRA exemptions will be for around 30% of transactions, whereas the low value exemption will be closer to 10–25%. I mean, the reality is, who knows how these are going to balance out, but at the moment, certainly the results from our survey are slightly different to some of the other results that I've seen elsewhere.
I think what's interesting is when we compare this to the acquirer survey we did, like what the acquirers expect to see. And so this slide shows some similar metrics, certainly some more variables here, but you can see that the acquirers actually think that the TRA, the transaction risk analysis, will be the most used exemption. So there's a little bit of a discrepancy there between the acquiring community and the issuing community. But order of magnitude is about the same. About 20 to 30 to 35% of transactions will go through either low value, we'll go through low value or TRA for a total of around 50% of the overall transactions. But I think what's really important to note, one thing that's really important to note on this slide is that acquirers are only expecting about 20 to 25% of transactions to require SCA. And that's a pretty consistent metric that we see across the card schemes as well. I remember seeing a slide from Visa where I think they had like about 21% required to step up in their expectations. It might be a little forward looking, I admit, but I think that, when we get into late Q1, early Q2, like that, this 20 to 25% SCA is very realistic. But I hear from a lot of acquirers today that they're planning on running everything through SCA to start, because they feel like that's their best strategy to make sure that the transactions are ultimately approved by the issuer, because there's some challenges around soft declines and the acquirers not being ready to retry transactions if an issuer soft declines it. So I think, long story short, we'll see a little bit more SCA in Q1 than we will in the second half of next year. But over time, SCA won't be applied broadly, from what we can tell. There will be a lot of exemptions that are available, which will ensure a very strong customer experience.
And actually, Spencer, just on that, just one thing to clarify, I've had a question in from the audience. What is a TRA exemption? The way that I look at this, so the TRA itself, your transaction risk assessment, for a lot of certainly merchants today, you do your own review as to whether you think a transaction is fraud or not. And really what the TRA exemption is all about is saying, well, if you think it's low risk and you feel that it doesn't need to be stepped up because it's low risk, then you can apply and say, this is low risk, please don't ask my customer to perform any kind of authentication, process the transaction. So it's really saying that I, as a merchant, I'm confident in what I believe is fraud and what isn't. So please, could you take that and apply this to the transaction? In its simplest form, that's what the process looks like.
Yeah, thank you, Catherine. And that's certainly an important nuance. And one other thing I'd like to add to that is that the transaction risk analysis is a consistent mechanism to allow merchant intelligence to be shared with an issuer. And if we treat it as that, and we don't view it as just a binary, yeah, we're requesting an exemption or not, it should ultimately help issuers make better decisions when it comes to authorization. Because the authorization rails themselves, they don't allow for that much data to be passed down that the issuers can decision on.
So on this slide, looking at, so a third of issuers will assess acquirers' TRA accuracy. So this is the acquirer has requested the TRA exemption. Will the issuers actually take note that that exemption has been requested or not? And what our survey showed is that 50% of issuers said no, they wouldn't. 50% yes, they would. But in terms of how they're approaching this particular scenario, certainly what issuers were sharing with us is that initially they want to be looking at their own data and using their models and understanding what's happening in transactions and what the fraud risk looks like. And it's only once they've started to understand their own world that they will feel more comfortable to start leveraging information that's coming in from other parts of the ecosystem, whether it's the acquirers and merchants or potentially third-party data as well. But what was interesting on this is it's actually showing a slightly different picture to some other analysis that has been out there, where it's closer to 25% of issuers saying they won't be looking at the TRA exemption flag. So I'd say that this is on the higher end of what's not going to be looked at. And to reinforce initially, this we're not expecting this to be a longer term view, but it's really starting to highlight the evolution and the journey that issuers are on in terms of all the data and information that's going to be available to them going forwards. The other point that I would make is issuers can actually use the TRA exemption in two processes. So right at the beginning of this session, Spencer talked about the authorization flow and the authentication flow. And actually a TRA exemption can be requested in either one of those two flows. And different issuers were going to leverage the TRA exemption in different parts of the process, or potentially both as well. So again, there's plenty of complexity here, and it's going to be all about getting that balance and the checks, having the checks and balances in place over time to really understand what the most powerful data points are going to be. Spencer, I don't know if you've got any other thoughts about the finding on this particular slide.
Well, I agree with you, Catherine. This is not a long-term view. More issuers will adopt TRA and use TRA from the acquirers over time. I think it's really encouraging to see that, about 33, the stat didn't show up on the slide, it got hidden, but in the green section of the pie chart, that's about 33% of issuers are going to look at the TRA accuracy and treat acquirers with more accurate models more favorably, right? And so that is a proof point of, hey, maybe we should treat TRA as a strategic differentiator, because the issuers are going to look at this. Even 33% is very significant, in my opinion, and we expect that to grow over time. And again, what I said earlier, it is a consistent mechanism to share intelligence. We should embrace it as that. But let me jump forward here, and we can carry on. So we also explored TRA, transaction risk analysis, as part of the acquirer study, and we got a sense of, okay, well, how do acquirers view TRA, and what's TRA going to benefit? And so you see the bar charts here on the left. About 91% of acquirers we surveyed earlier this year expected TRA to help them maximize exemptions, pretty straightforward. And about 82% expected it to help them reduce fraud. And you can see some quotes here on the right that correspond to the no answers and the yes answers. And you can see that, hey, like the ones that are answering no to the reduced fraud, maybe their fraud rates in their portfolio are low, and so they don't think that TRA is going to help that much if their fraud rates are, below 5 basis points or something, for example. But on the positive side, a lot of these acquirers are answering yes, and they view the TRA flag as an ability for them to invest in better decisioning, and they think that widespread adoption of SCA will reduce the fraud ratio, which will then allow them to offer more and more TRA exemptions. One thing we didn't cover is the fact that, hey, if you do want to offer a transaction risk analysis exemption, the acquirer's fraud rate has to be below a certain threshold. And so if the transaction is between 250 euros and 500 euros, that's 1 basis point, which is very unrealistic, right? Like, what acquirer across their entire portfolio is going to have a fraud rate under 1 basis point? So most acquirers we talk to aren't really shooting for that. You have the 100 euro to 250 euro threshold, which is under 6 basis points. Much more realistic, still something to strive for. Not every acquirer is there now. And then you have the 25 to 100 euro band, which is under 14 basis points. And so from what we can tell, many acquirers are able to offer that band, the 25 to 100 euro, and are striving to offer the 100 euro to 250 euro, and not really shooting for the 250 to 500 euro, because 1 basis point trying to get there will ultimately result in too many false positives at the end of the day, declining too many good customers.
So a bit of a theme that you'll have seen on the slides that we've shared so far is the amount of data that is part of this process. So towards the beginning of this session, Spencer showed a slide where it illustrated the difference between 3D Secure 1.0 and 3D Secure 2.0 and the volume of data that's going to increase as part of that. And of course, in the more recent slides, we've just talked about exemption flags that are also going to be available that issuers can use to help determine whether a transaction is fraudulent or not. Having all this data is great, but you need to be able to do something with it in order to be able to really get value from it. And so one of the areas that we looked at is what issuers are doing with that data. What systems are they using, whether machine learning and statistical analysis or more rules-based engines. And certainly for a lot of issuers, they seem to be on a journey, having started out with rules engines, maybe a little bit more manual processes, and starting to either already evolve or thinking about evolving into more statistical type models. And so in terms of the investment that they are looking to make as a result, partly as a result of this new regulation, this chart clearly shows the amount that's already invested in those tools. Actually, I'm surprised that's not a bit higher, if I'm honest, in terms of what's already been invested in either machine learning or rules-based engines. But certainly what's very clear is that there's a very large percentage that are wanting to continue to invest. It's over 75% of the population that are looking to do that, both in currently 2020, 2021. But some haven't considered investing in this at all. And for me, I think this is where it's really going to show the differentiation between issuers and those that are able to manage an efficient and effective authentication process and minimise the amount of churn that they have of their cardholders. The last thing any issuer wants to have is put barriers in place of their card holders, and they can't use their card because they can't check out online. And so for those that are investing and really understanding what to do with the data and how best to use it, are the ones that are clearly going to be ahead of the game, at least initially, and it'll be interesting to see how it evolves over the next few weeks and months. So building on that a little bit more, the more data you have, the more accurate that you can be in making your decisions. And so, yes, the new 3D secure protocols have got much more rich data as part of them, but the more that can be enriched and built on, the better decisions issuers are going to be able to make. And for me, this one was a bit more of a positive story in terms of the thought process and the investments that issuers were looking to make to supplement data that was being sent to them with other third-party information. So more than 75% of the issuers that were part of this study were planning to invest in supplementing their data to enable them to balance and make the right decisions. Maybe it's a little contradictory actually to the last slide we showed, where they seemed less reluctant to invest in the underlying platform of the machine learning or the rules-based engine, but they are willing to get more data and to really make sure that they're getting the most out of the information that customers, merchants and acquirers are going to be sharing with them. I don't know what your thoughts are on that view, Spencer.
Well, I think one of the key things to remember is, like, neither the acquirers or the issuers have a lot of experience collecting a ton of data from their merchants. In fact, GDPR disincentivized merchants from sharing data with anybody. So you only sent the data that you needed to send to process a payment to your acquirer, and 3D Secure 1, when you wanted the liability shift, it only required 10 fields, and none of them were particularly sensitive from a PII, a personally identifiable information standpoint. And so at some level, GDPR and PSD2 are a little bit conflicting in that way, where it's like, hey, PSD2 says share more data, like it'll help you, it'll benefit you, but GDPR, like, tightens the screws and says, oh, I got to be careful, I don't want to get fined by the regulators. And then, to make matters worse, the courts in Luxembourg, I believe, shot down Privacy Shield 3 months ago, which was a mechanism to allow for the cross-border transfer of data from the European Union to the US. And that only made merchants even more gun shy. But make no mistake, sharing data will benefit you. And there's ways to share data in a compliant way with GDPR. And the thing when it comes to third-party data is, like, there's no history that the acquirer has or the issuer has around this data. And so one of the last things we looked at was, like, what is the importance of data, and what data do you use now? So as you can expect, the issuers use the payment amount and the instrument. I mean, that's passed through as part of the authorization rails. They've had that for quite some time. And then, as you go down this slide, you see less and less adoption of data. But it's really encouraging to see that, hey, like, these issuers are using or planning on using a lot of the PII, email, IP, phone number, addresses that Ekata can, enhance and supplement. And the supplementation is really helpful because they don't have the history of that data, right? To have a really good data strategy, you need to see data for quite some time to be able to identify the patterns and understand, hey, is this a good customer? Is this a bad customer? But I wouldn't say that it stops with the PII. Like, a data strategy across the board will benefit anyone. So with the people we talk to, they try to leverage their internal data before moving on to external data. But ultimately, collecting and storing data in a compliant way with GDPR will enable, and also, allowing European consumers to exercise their rights, of course, under the regulation, will enable better decisions across the board. And so I think it's really encouraging to see the additional data sharing that's happening throughout the ecosystem, and issuers are planning on investing in data strategies, and merchants and acquirers should do the same, because, like Catherine said, the more data you have, the more accurate your decision is going to be. This has been a really great conversation so far, and we have a ton of questions, so we really appreciate those. Always like that versus the alternative. So let me wrap up with some closing thoughts, and then we will go to questions. So first off, issuer readiness isn't quite where it needs to be, but it's further along than we previously perceived. And as we mentioned, we're all working towards the same goal. No one in the ecosystem wants to decline transactions. Like, it's in everyone's best interest to ensure that consumers have a really good experience and that transactions are ultimately authorized. So keep in mind that we're all working together. It's not issuers and acquirers butting heads and going against each other. We're all working together, and I don't think that Q1 is going to be a disaster by any means. There'll be a little bit of stumbling in January, to be sure, but overall, PSD2 will be a very positive thing for the ecosystem. And then finally, an exemption strategy is key. At the end of the day, strong customer authentication is friction, and consumers don't like friction. They like a frictionless experience, and maybe 3D Secure 2 at some point will be the frictionless silver bullet that it's promised to be, but that's not the case today. And so invest in an exemption strategy and make sure that you're only stepping up consumers that need to be stepped up because there's a fraud risk there, or the regulation requires such a step up. And with that, we're gonna have one brief poll, and then we're gonna jump into a Q&A. So the poll is simple. If you would like to learn more about Ekata, select the first option. Or if you just want to be notified about related webinars, select the second option. Or if you don't want to be contacted whatsoever, you can just leave this poll alone. We'll give this about 20 more seconds, and then we'll jump into the Q&A. Okay, Mélisande, I think that's plenty of time. And we have a lot of questions in 15 minutes, so let's dive into it.
Let's start right away. And thanks for sharing your insights, Catherine and Spencer. First question, does the fraud counter increase in case of a chargeback for a transaction which has been secured by SCA? So in the case of friendly fraud, for instance.
Yeah, I can take that one. Friendly fraud is certainly a challenge in the ecosystem, and unfortunately, it does count towards the fraud rates. Any type of fraud counts towards those. So yes, those do count.
Okay, and how are non-credit card transactions impacted by PSD2 and SCA, for instance, direct debit and bank transfers?
So let me take that one. In terms of the study that we did, actually we focused on the credit and debit card payments. We didn't actually cover off direct debit and bank transfer on these. So I'm afraid I'm not able to give some insights based on the companies that we spoke to in this particular scenario. But the reality is the same. If you need to make your authentication process as frictionless as possible. The more complicated you make it, or the more that the customer feels that either, I don't know, if it's something like a password that they have to remember, or it's something that disrupts their thinking pattern, their purchase pattern, it's going to put them off, and it's going to push them either to a different method of payment or potentially a different merchant to do their shopping. So those are the principles that I would say are the same no matter what payment method you use.
Yes, makes sense. Thanks. A question about EEA versus non-EEA payments. How is the overall fraud rate of a merchant calculated? Is that separate or combined or weighted otherwise?
Yeah, so one important thing to note, and it's a common misconception, for the regulation and to allow for the TRA exemptions, the fraud rate that matters the most is the acquirer's fraud rate in aggregate, right? At some level, the individual merchant's fraud rate doesn't matter. But that being said, like, merchants have a lower fraud rate are going to be much more attractive to acquirers, because those acquirers will then be able to use that as a way to bring their fraud rate down across the board. I believe, and Catherine, correct me if I'm wrong, I believe that when you're calculating the fraud rate at the acquirer level to offer exemptions, we're looking at transactions that are only in the EEA. Is that the case? Do you know?
That's my understanding as well. And I guess to remember as a merchant, each of your merchant IDs, each of your MIDs will be assessed on the fraud that's going through that merchant ID. So actually, for a merchant, you go a lot more granular than the question that we're being asked here. But yes, from an acquirer perspective, Spencer, that's my understanding as well.
Great, thanks. So in the case, we always ask for SCA. What is your gut feeling on the risk to get declines from the issuers nonetheless due to their risk reasons?
Yeah, this is, and I'll take this one, Catherine. If you have things to add, please do. So this is a common strategy we're hearing, both from the acquirer level and the merchant level, which is just, hey, let me run everything through SCA at the start. It's going to be the most likely way that I'm able to get the transaction authorized. And ultimately, the answer to this question really depends on readiness across all three parties: merchant, MPI, or acquirer, if the acquirer runs the MPI, merchant plugin, sorry for the acronym, and the issuer, and the access control server, really. So you're looking at the authentication rail. So the key question is, like, are you on the most up-to-date version of 3D Secure? Every party in the ecosystem. Because if you are, then that's a pretty sound strategy, right? Because there will be frictionless flows, and not every consumer is going to be stepped up to do a two-factor authentication using an SMS or to log into their bank or whatever. So your authorization rates will be okay if everybody's on 3D Secure 2. But if you're not, and anyone in the ecosystem is falling back to 3D Secure 1, the consumer experience is so bad that there's so much drop off, so much conversion drop off. And then furthermore, like I mentioned earlier, it's a little counterintuitive, but even if the issuer is on 3D Secure, I think we're 2.2 or 2.3 now, on the most up-to-date version of 3D Secure, and you're running it through that and everything's great, and the issuer accepts liability for it, the authorization decision is independent of that for some reason. And on that roundtable earlier today, I asked that question to one of the parties that acts as both an acquirer and an issuer, and ultimately it's because the systems are legacy. They don't talk to each other. And so you have this authentication system that has all this data to make great decisions. Should I take a liability for this transaction or not? But when the transaction comes through the authorization rails, most issuers aren't connecting those dots. And so if you authenticate a transaction, the chances that it's authorized is lower than it would be otherwise across the board. And so that's just something you need to keep in mind where you're balancing the fact that, hey, do I want to apply for exemptions? And maybe the issuers aren't ready to do those exemptions and they'll soft decline the transaction. And maybe my acquirer is not ready to retry those soft declines. I do believe that running SCA on everything in January is a good strategy, but you're gonna want to pull off of that pretty quickly because there's going to be conversion issues for the consumers no matter what, and the issuers are going to decline more authorizations if they have liability for those transactions.
I think there's one other thing I'd add to that as well, Spencer, that is causing a bit of noise in the ultimate results in this, and that's the fact that card schemes at the moment are having to stand in for issuers that haven't enabled their bins yet. And where they're doing that, it's causing an increase in, or a decrease in authorizations, I should say. So would it be a strategy longer term? Possibly. Doing it right now, you're not going to see the same results as you will longer term because the networks aren't going to be running that stand-in process as much as it's being leveraged at the moment.
Okay, clear. Good addition. If using a TRA exemption, does that mean that the merchant waived their right to liability shift for that transaction?
Yeah, that's the case. If you apply for any exemption, the liability remains on the merchant side of the ecosystem. I mentioned earlier that we have heard from some acquirers that are exploring the possibility of taking on liability on behalf of their merchants. I don't know how mature those offerings are and if they're even end up being rolled out, but that's part of the trade-off, which is, hey, if you want to avoid the friction and you apply for an exemption, you as a merchant maintain liability in almost every case. But also, you as the merchant are in the best position to assess the risk of that transaction because you have access to the most data. You know if that consumer is someone that shopped with you before. If that consumer is buying, a 10 euro pair of socks, like you don't need to run that through 3D Secure. Like there's no need for that. Like that's not going to be fraud. There's no like, black market sock exchange out there that people are like selling socks on. But if it's a, €5,000 TV, maybe you do want to take a liability shift for that if it looks like it's a risky transaction. And you just have to balance those trade-offs of knowing that there's less chance that it's going to be authorized, but you're not exposed to that fraud. But keep in mind that even if there is a liability shift, that fraud rate still does count towards fraud rates. So like, when it comes to the card schemes and their, chargeback programs, like a lot of merchants think that, oh, the issuer takes liability, I'm good, but you'll still, like, if that's a chargeback, that still counts towards your own fraud rate and the acquirer's fraud rate. So keep that in mind.
Yeah. Another question for you, Spencer. Any thoughts on whether the rules on SCA actually will reduce fraud? Fraudsters tend to find new ways to make money, moving fraudster-initiated fraud to social engineering, taking advantage of exemptions, etc., etc. So what is your take on that?
Fraud's not going to go away. Fraudsters move to the area that has the least resistance, right? And so what's going to happen, probably, I mean, this is just my theory, I should take that with a grain of salt, but what's going to happen is, fraud in Europe on transactions that are in scope of SCA, that's going to go down across the board because like now it's a hassle for fraudsters to do that. So the fraud's going to move to mail order, telephone order transactions, which leads to your point about social engineering. That's something that if you're a merchant, you need to start training your call center staff on to look out for that. It's going to move to one leg out transactions. So you should keep an eye on credit cards that aren't issued in the European Union. Like you still want to be able to accept those, but it's going to be more likely that those transactions are fraudulent than transactions that are in scope of SCA. But fraud is a full-time job for fraudsters. Like they're not going to stop just because PSD2 comes out. But overall, PSD2 will reduce fraud exposure across the board in Europe. It's just going to move elsewhere.
I think the other way that I look at that scenario, Spencer, is we've talked about friction for customers and trying to minimise that. Fraudsters don't like friction either, and SCA is bringing them friction because they're now going to find it much harder to use stolen cards and information online unless they're non-EEA issued cards. So, for example, US issued cards, I would have thought that we're going to see an increase on fraud on US issued cards because they've now become the weaker link in the ecosystem. And so fraud's going to migrate to situations like that, as you described, out of scope. US issued cards will be out of scope, but they can still be used on websites in Europe. So this is where it's the fraud screening and trending needs to be adapted and evolved to match that as well.
Good point. So about the exemptions, when developing a plan for leveraging exemptions, we are hearing more and more about going straight to auth and retrying on soft declines versus leading with authentication. The logic for this appears to be the following. Issuers and ACS providers have not integrated authentication and authorization solutions to manage the counters required for low-value exemptions, or issuers can also apply TRA on auth, and they are struggling to migrate to 3DS 2.2 or implement RBO authentication. What is your take on this? What is your opinion?
Yeah, that's a tough question. So I would warn you to be really cognizant of if the acquirers are ready to handle soft declines. I just heard today that one of the leading issuers in France was on the call on my roundtable earlier today, and they were saying that it was something like 90% of transactions that were soft declined by them, they never saw it again. Like the acquirers didn't do a retry. I agree that there are some benefits to using the authorization rails to go for an exemption instead of the authentication rails, but again, there's trade-offs, right? Like the authentication rails give the issuer access to a lot more data, and so that data sharing has a lot of benefits too. I hear most commonly that it's going to be using the authorization rails long term, but I'm not aware of the fact that you're saying that the authentication rails, there's no mechanism to count for the low value exemptions and to account for that. But I'm not surprised to hear that either. That seems like a mechanism that wouldn't be a top priority for the issuers to implement. So in summary, really understand if your acquirers are ready to handle soft declines and to retry those. Because if they're not, then you probably want to go the authentication route, or do A/B testing, right? Like run part of your traffic through one way, part of your traffic through the other, and see what happens.
Okay, so we're almost at the time, so we have time for 2 more questions, and we will definitely get back to questions that we did not have time to include in this webinar. So one question is about merchants that have an average transactions, higher average transactions value, so over 250 or even over 500. What would be your recommendation for these merchants? How should they proceed?
So for me, this is where whitelisting becomes important, and to have that kind of process in place. Again, some issuers are more advanced in offering whitelisting than others, but that's where obviously merchants have the opportunity for their customers to be in control of the friction that they go through, particularly in merchants that they shop at on a regular basis. And certainly is expected to be the case for these higher value purchases. So whitelisting would be my recommendation in that situation.
Okay, thanks. And the last question for Spencer. So you speak with a lot of people in the industry. You just had a roundtable earlier today. So what does the industry feel the impact on authorization rates will be after January 1st? So what is the common opinion there?
The general sense is that authorization rates will go down in Q1. No one really knows by how much. It's all speculation. Our sense is that the authorization drop will be mitigated very quickly. I would say certainly by the end of Q1. And then some of the bigger geographies like the UK and France that don't go live until September and April respectively, like they'll learn from the rollout in other countries. And so the bigger geographies will have less of an issue in the second half of next year. But we do believe that overall in 2022, when we look back on this, the authorization rates will be up versus where they're at today. But this is still an open question. And for everyone listening, just know we are doing a couple more webinars in this series, and our next webinar that we do sometime in Q1 will address this specific fact. What did we see? What happened? And what can we learn from that? And we're all waiting eagerly to see what that is. And the best recommendation I can make is just to be vigilant, monitor everything you can monitor, and make adjustments quickly, and be ready to do that, and have some resources set aside to move fast to make sure that your business is less impacted by the upcoming rollout. Okay,
well, brilliant. Thank you, Spencer, and thank you, Catherine, for sharing your expertise on this very complex matter. And I'm looking forward to the upcoming series on this particular topic. And thank you, audience, for your time and also for engaging with Catherine and Spencer and for all your questions. We will send you a link to the webcast shortly. And as I mentioned, we will get back to questions that we did not have time to include in this webinar. I wish you all a very good rest of the day and hope to see you next year. Thank you. Bye-bye.
Bye.
Bye.